Seconds. Hi, I'm Louis McGraw with McGraw Realty.
Ken Martello from RPM Platinum Capital.
And Beth Brooks, and on today's segment, we're going to talk about, should you consider buying a home in today's market? Does it make sense, or is renting a better option at this time?
We're going to ask our expert.
Well, I read a very interesting article today, and the long short of it was that in 74% of the country, buying makes better sense than renting. It's actually cheaper to buy than rent. And sometimes, if you just want to do some rough numbers, you could take what your average rent is for your 2 or 3 bedroom apartment, and then just to have a formula, take a 20% down payment at 4.5%, add a couple $100 for taxes, $100 for insurance, and you can compare the two payments. We're not even talking about the tax benefits of buying, but you'll see that those numbers work out very favorable to buying.
Okay.
In many cases, probably about 40% of my loans are FHA loans, which typically are 3.5% down. With PMI, which is private mortgage insurance, the numbers still are working where that PMI payment is cheaper than what the rent would be for that same size property.
Okay. Ken, with FHA loans, what are the limits that you're seeing for, is it the same for California as it is for, say, Missouri, or what are you seeing for the limits on FHA?
Well, once again, we're in Los Angeles County, so our limits right now are $729, $750. That's actually scheduled to go down to $625, $500 as of October 1st. So let's just use that as our loan limit.
Okay.
So there's 2 levels of, I would say, conforming loan. First you have from 0 to 417, and then from 417 to 625, 500.
Okay, now, for conforming loans, what does that mean for a consumer? Because, you know, we understand what you're saying, but what is a conforming loan? What does that mean?
A conforming loan is basically just the size of the loan and who's doing the loan. So most conforming loans, again, are below 417 for the loan amount.
Okay.
And that's the basics.
Okay.
Above 417, the rates start getting a little higher, and then if you go above that 625, definitely a lot higher.
Now, some of you may be thinking, okay, so I've made the decision that it probably makes more sense for me to buy, but again, with all the things we're hearing in the media these days, what are some of the issues that are coming up for people that have made the decision to jump in and buy? What are you seeing as things that are tripping people up, helping people along? What are you experiencing at this time?
Well, today you have to qualify for loans. That's the simple.
Oh my gosh.
It's a miracle. You have to be able.
Why would you have to do that?
You have to be able to afford the payment. So the bank is going to verify your income, and I figured at one point the banks verify your income in 7 different ways. Taxes, W-2s, pay stubs. They're going to talk to your employer twice during the transaction. They're going to ask the IRS for your tax transcripts. They're going to look at your bank to make sure that the paycheck is actually going into the bank. So there's a lot of different ways that we can verify.
Okay.
They're actually dotting I's and crossing T's
Definitely.
now. Okay.
And then they're probably crossing the X's too.
Okay.
Not just throwing
Good to know.
darts.
Yeah.
So that's the number one thing, is we have to have enough income to qualify. So generally speaking, 45% of your gross income can go towards your bills being anything that would show up on the credit report, car payment, student loans, credit cards. Sometimes you see timeshares, sometimes you see alimony and child support that you have to factor in. So 45% of your gross income can pay for that and for your housing payment. So that's the basics of how the lender is going to look at your income.
Okay, let's take revolving versus non-revolving debt, and how does that affect them?
So do you mean revolving debt would be like a credit card,
Correct.
car payment,
Right.
Student loans versus, like, say, groceries or cell phone bills?
Right. So let's just say, what are the lenders, and we can talk about that in a different video, but what are the lenders looking for? So let's just say you have 10 credit cards, and all of the credit cards are below the 50% max limit.
Okay.
What are they looking for there versus if you have, say, out of the 10, 5 of them are maxed out and the other 5 are, say, you know, within the, you know, the bottom 10% of what's owed on them? How does the lender factor all of those things in there?
So we actually have two issues in that question. The first one, with maxed out cards or being over 50%, you are most likely going to have some type of credit issues and credit scores that are lower than if you had lower debt ratios or lower debt amounts on those credit cards.
Okay.
Now, a question on that, and I think a lot of people have come across this, I know personally that this has happened. Right now, banks are trying to curtail on some of those cards, so people who have had large limits, the bank sends them a letter and said, we're reducing your limit. So you may have been below the 50% line and of no action of your own, you're now suddenly looking like you've maxed out a card. Is there a way that you can explain that for people? Is that just gonna count against them?
It's basically going to count against them. If they say if you had a $10,000 limit, you had $5,000 on a card, you're at 50%. Ideally, you want that below $3,000, which is 30%, or 0 is ideal. But at the 50% mark, once the lender reduced that line of credit or that credit card down to $5,000, now you're 100% maxed out on that card, and that definitely dings you. I've actually seen some of the credit cards where they've reduced the limit to lower than what their debt was, so right away these folks were encountering penalties and fees for being over the limit, which I think is just scandalous, but I've seen it in multiple cases.
Wow.
So the other issue we have with your question, Lou, is the debt on the credit card. So the lender typically doesn't care about the total balances on the credit card, but just on the monthly payment.
Right.
So that's how we're going to figure out, with those debts, is the house affordable? Everything's broken down to a monthly payment.
Okay.
And you're gonna help people to look at that and maybe make some decisions ahead of time of pay this down, or they maybe aren't looking at their credit cards right now and realizing, oh, if I have the money, I might be better off to pay this down a little bit and get under that 50% before we go ahead and apply for the loan. Are those some of the things?
Definitely, we'll look at that, and you know, a lot of times I talk to a client, one of the first questions I ask is what payment range you're looking at and what's the payment you're looking at.
Okay.
So sometimes that correlates to their income, sometimes it doesn't. So let's say if they have a lot of debts and they feel they can afford a larger property, then we can look at the debts and say, okay, well, if we paid off A, B, and C, we can get up to that $400,000 or $500,000 level. Without that, we're at 340, say.
Which kind of brings up the next point, people who are sitting with their cash right now and wondering, do I pay down my credit card, will I need this for a down payment? How much do people at this point in time need to have as a down payment? Because that's, you know, another issue for people, is where's the best way to distribute that cash?
That's an excellent question. So for the down payment, it could be 0, it could be 40%, depending on what type of loan you're doing. FHA, which is about 40% of my business, is 3.5% is what you need for the down payment. So that's pretty little.
Yeah.
VA is 0% if you have the eligibility. With your conventional conforming loan, which we talked about earlier at 417, 20% is the standard. Up until probably about 2 or 3 months ago, and Fannie Mae and Freddie Mac adjusted their pricing, where now 25% is going to be the standard. So that's where your best terms are going to be when you come in with that extra 5%. So we could run the gamut of what we need for the down payment, and we'll look at the debt and say, does it make sense to pay that down? Another thing about debt, real quick, if you take the dollar amount for your debt, divide it by 45%, and that's how much income you have to make just to support that debt alone. So that's a pretty big number in a lot of cases.
So if it sounds to you listening right now, there's so much information, and what occurs to me, and I'm sure to you, Lou, for clients, is that education is key.
Absolutely.
And being prepared. And what we love about Ken and his team here is that you hold seminars and you really educate your clients. And so you don't have to listen to this video and know every single thing. You need to pick the right type of professional to deal with, who's going to educate you, going to prepare you. And maybe you want to tell them a little bit about the seminars you do for people and how you go about that.
Thank you. We do 2 seminars a month, typically on a Thursday and on a Saturday. We rotate them every 2 weeks. They're here in our Torrance office, 23607 Hawthorne Boulevard. So you can actually look at our schedule at learntobuyahome.com. It's the number 2, so learntobuyahome.com. and it will have our latest seminars on there.
Very good. Thank you again, Mr. Ken.
Thank
It's
you.
been a great pleasure.
Pleasure, thank you,
And,
very informative,
Until the next time,
Thank you.
we'll see you.
thank you.
How's that?
It's great.